Each one of these is going to have a point score, and you're going to want to take some notes and tally up your points. We will go through all 8, and I won't put you on the spot to ask you your scores, of course, but I'll also give us an opportunity at the end to say, all right, what might we do to set an intention, to take some action and do something about it? So I want you to learn something today, but I also want you to set an intention to do something about it. All right, so let's dive in. So this is our quiz. Let's start with question number 1. Now, I will read your question and I will give you your answer choices, and then you're going to note your score. So question number 1 is about financial records. Are the financial records of the business accurate and up to date? Do you have at least 3 years of clean financial statements? If your firm has been changing the chart of accounts and it's kind of a mess to look at your numbers year to year to year consistently, you're going to say not likely. Okay. So if you have pretty clean balance sheet, income statement, profit loss statement, tax returns easily accessible, your books are organized and transparent for potential buyers, awesome. You're going to give yourself 10 points. And if you're somewhere in the middle, you're going to say 5. I literally just ran into this issue today. My client, who I would have said would have been a 10-pointer, just emailed me and said, well, we've had some changes in our accounting back office, and unfortunately, I think the reports we sent to this potential buyer are wrong. And here we go, right? And so it's a really important thing to make sure we have clean financial records. All right, so that's question 1. Question 2, revenue predictability. This is a really important one for many buyers because ultimately, what is value, right? It's what the buyers perceive. And the more predictable we have, the more predictable stream of future cash flows, the more predictable revenue, the more predictable profit, the less risk perceived in the business. So what makes predictability? Well, there's a couple things. 1, and 10-pointer, if you have a recurring revenue model with more than 40% of your revenue coming in this predictable subscription model, just like when you put in your credit card for Netflix, something like that. Software companies have it, but other companies have it too. You might be a services business that has it. So you'd give yourself 10. If your revenue is growing steadily year over year, above the category, above the industry standards for for what you're seeing, give yourself a 5. If it's consistent, kind of matching, but not exciting, give yourself a 2. And you're going to do a minus here. So be honest, if your business is highly dependent on a few customers, you're going to do a minus 10. High math here, right? But the minus 10 is really important because we're going to talk about revenue concentration. Revenue concentration. There's a classic Pareto. Let's just put it out there, right? 80% of your revenue is coming from 20% of your customers. All right, so that's one benchmark. Another benchmark might be if any few customers represent, or any one customer represents more than 15% of total revenue, it's probably going to get a red circle by the buyers who are reviewing your information and say, what can we do to mitigate that risk? So you might have a situation that needs to be addressed if you have significant revenue concentration. I have a client that's in that situation right now. They have contracts, which is great. They kind of fall under this committed revenue for long-term contracts, which are pretty significant. It's like 5-year contracts, 10-year contracts. However, they have 1 or 2 highly, highly significant concentration, 2 clients that are representing about 60% of the revenue. So of course, the buyer has been asking about it. And what can we do to mitigate that risk? Question number 3. This is about business independence. Said differently, is your business independent of you? Do we have owner dependencies? If we do, there's an impact on value because the buyer's going to wonder, if the owner's not there, what will happen? What will happen to our customer relationships? What will happen with our employee satisfaction? What will happen with our processes? Are you the only one in the company who knows where to kick that machine just in the right place? I wasn't doing a workshop once, and the owner who was talking said, yeah, I had to fly all the way out. I had to work on this rocket ship, and I was the only one from my firm who knew how to do it, and it was really cool. Well, that's great, but that's not transferable knowledge necessarily. So that's the context of this question. Can your business operate effectively without your daily involvement? Do you have people, processes? Are they documented? You have people in place, management team, etc. All right, so definitely give yourself 10, somewhat give yourself 5, and not likely give yourself a 0. And I want you to do this for each, okay? A, B, and C, you can give yourself a max score of 30, right? So if you think that's a 10, go for it. Give yourself a 10 on all of these. Love it. Give yourself a 10. Your max score is 30 potential, and your minimum score is a 0. So be honest here. All right, look in the mirror on all of these. So question number 4. Question number 4 is about growth potential. This is super exciting because buyers are buying what you've done in the past. They're acknowledging that because they want to believe in the future of this business. They appreciate what you've built and they're going to take it to the next level. So what gives them the confidence that what you've built and what you've resolved, what you've delivered is going to be something they can harvest in the future? And there's ways to show that, but look, hope is not a strategy, right? And so if you have ideas for future things that you've intended to launch, but you haven't launched them yet, they're not necessarily going to be super excited about that. They want to know and see what's been proven. So when we think about growth potential for your business, are there opportunities for future growth that would excite buyers? So there's a lot to this question, all right? And depending how you want to answer it, given some of that context that I described. In this one client example where I talked about the concentration risk that they're having with clients, and the same token, the buyer is very, very interested in taking this model and expanding it in this particular geography. So for that particular client, I actually probably would give it a higher score. So kind of look at these independently. Growth potential, definitely, likely, or not likely. Question number 5, diligence preparedness. What is diligence anyway? Well, it's really the focused time that a buyer is going to spend looking at all points of your business. Ultimately, how much time is it going to take depends on the situation. But we're on a clock. Once we've signed an offer letter, the timeline for diligence is stipulated. So let's say it's 90 days. Okay. If our books are clean and we've got our financial records and we're able to put things together and maybe we've already started preparing, that will make that process go more easily. And I see it with my clients. We set up online data rooms as part of our process. We're getting ready. If we've been working on getting our business ready for a sale, we've been organizing all along the way. Gosh, it makes it so much easier because when we get to this point of doing diligence and going through the process, they're looking at financials, legal, intellectual property, employment, benefits, you name it. The list is pretty long. As part of our process with clients, we'll prep and we'll get all the documents ready that we can. Then when we dive into the actual diligence process, of course, we're going to get request lists from the buyers and we'll work with our collaboratively with the attorneys to make sure that everything that needs to be in there is, as well as working with tax advisors. There's a whole lot of people that get involved in these deals, especially on the diligence side. So being prepared is super, super important. So is your business prepared for diligence? Do you have a plan to handle buyer questions and document requests? People who decide to sell their business on their own, look, you got to be heads down and running your business. That's your number one job. Keep your foot on the gas. Diligence, time for diligence, all the stuff associated is time and money. And it's great to have support and being prepared. Is your business structured to pass the scrutiny without major red flags? So give yourself some points here, 10, 5, or 0. All right, question number 6, the post-sale transition plan. And Paul teed this up at the beginning of today's presentation. There's all kinds of reasons why you might or might not be ready for a sale or ready for a transition. And I teed it up too, ready to sell versus sell ready. You might not be ready to sell. The business might be sell ready. We don't know. And part of this quiz today and part of this dynamic is just getting yourself thinking about it. And where are you on this continuum? Do you have a sale plan, post-sale plan? Do you know what you want to do after the deal closes? Are you able to ensure a smooth handover? So many times we hear stories that people are not prepared. They go through a sale. I hear it on my podcast all the time. These stories and they're very unhappy stories. And the statistics back it up. 75% of business owners express that they're not happy 1 year after a sale, but not our clients because we've been working on it together for a while. I have one client who has been working with me for 10 months. And wouldn't you know it, that little bluebird came out of the blue and said, I'm interested in buying your business. And we're exploring that. And he said, Laurie, if I hadn't been working with you, I don't think I would have taken that phone call. And it's from a strategic buyer, not a public company, but a pretty well-known national firm that he's pretty excited about. All right, so you're going to give yourself some points here. All right, question 7, business valuation. Many business owners do not know what their business is worth. So this is a very literal question. Have you had a professional valuation or market comparison of your business in the past 2 years? It's not a guess. It's not, oh, I heard this at the club, or I read this article, I heard this podcast. It's not that. It is a realistic asking price based on industry standards. And I'm only giving you 2 options here, a yes or a no. There's no maybe. Question 8. I mentioned a little bit ago, this collaborative deal team. I like to call it the red team. Who is on your red team? When it's time to go, you got to go. It's a small group, probably some internal folks that are maybe signing a confidentiality agreement, maybe not. In my experience, when I shared earlier, the company I was with had an exit to a global company. I was one of a dozen or so key executives that was part of the transaction up front, as well as in the transition, integration, and beyond. And we had a very tight deal team, and it extended from there. We needed people to support us and help us in getting the diligence information. You can imagine, for a $1 billion company, there's a lot of diligence to do. And it was super, super important to have communication streamlined and to have the right professionals on the team who, in this case, were external. And in lower middle market, hey, you're not going to have deal team professionals necessarily in your business, but why would you go about on a deal by yourselves? You haven't built your business alone. You're probably not going to go through an exit process alone. Wouldn't recommend it. You can, and don't just take my word for it. Lots of people tell the stories of, oh, I wish I did this, or I wish I had that support. And we don't want you to exit with a regret. And that's why you got to surround yourself with the right folks. So do you have a team of professionals with M&A deal experience ready to support the sale process? So if you have a corporate attorney who's been your company attorney for 20 years and you go golfing and you're great friends, that's awesome. But if they don't have M&A experience, we'll recommend, we'll make some recommendations for you. Likewise, if you have a tax advisor, accounting advisor who has been supporting your company, awesome. They'll be great for the diligence process, but perhaps we'll want to include some other folks who have M&A deal experience to help you understand the tax implications and so on. So 10, 5, or 0. Now, that's all. I said there were 8 questions. There's certainly more we could talk about, but today's presentation continues on. So higher math, I want you to get your calculators out and tally up your scores. Here's the shorthand. If you are in the 70 to 90, wow. Awesome. That's fantastic. It's a pretty good indicator that your business may be ready to sell. Of course, it's worth a conversation to see what we can uncover there, but it's on the right track for sure. Now, if your score was between 40 to 70, what I would say there is, hey, that's okay, right? And everything comes in due time. It could be that it's your next step is to invest in the business as an asset. For many entrepreneurs, the business is the largest part of their net worth. It could be 70 or 80% of your net worth. And guess what? It's in one thing and it's illiquid. Would you make that stock investment now that you know the situation? So we want to help you take some chips off the table if that's what you want to do. And the go or grow decision can be something that you do over time. Maybe every 90 days we make and revisit that decision. So if your score is under 40, then okay, we got some work to do here. Let's identify the gaps. Let's talk about where we can address the risks in the business and where are the strengths we want to double down on for value enhancement. So there's some work to do there. All right, so now you know your score and you know where you are. This is the cheat sheet of the 8 sell-ready factors: that your financial records are accurate and up to date, that your company revenue streams are predictable, your business is independent of you, your future growth potential will excite the buyers, you're prepared for due diligence scrutiny, you've got clear intentions for post-sale transition for you personally, You've got a realistic asking price and expectation on your business valuation. And you've surrounded yourself with an experienced deal team.